And what we saw in Q2 was basically liquidity at best flatlining, and probably in some cases actually falling. And two events were really paramount. One was, if you look at the Federal Reserve balance sheet, the Federal Reserve balance sheet was under downward pressure. In fact, let's be more specific and look at liquidity injections. Liquidity injections by the Fed basically came off a bit. And that was largely because of a phenomena which saw the tax take. It was tax paying season in the US, and the tax take basically bloated the Treasury General account, which is basically a deposit account, if you like, for want of a better description, held at the Federal Reserve by the US Treasury. So the Treasury was accumulating cash, and that cash was basically coming out of money markets. And so liquidity in the US system was challenged through that period. The other thing that was significant was that the People's Bank of China, in the wake of the Lunar New Year holiday, began to tighten monetary policy quite aggressively. And those two acts basically created a liquidity air pocket in markets. And that's why we've had, if you like, a fairly difficult Q2 and maybe Q3 so far. I think if we look forward into the back end of this year and probably into 2025, it now seems fairly clear that the Federal Reserve, at least, is pursuing now a more aggressive easing policy. And that was foreshadowed by the statement that Chairman Powell made at the Jackson Hole Summit a few days ago. So basically, Powell said, number one, that inflation is pretty much beaten. Number two, that employment or maintaining employment, avoiding unemployment, was now a bigger criterion for the Federal Reserve to start watching. And the third thing that they said was that interest rates cuts are coming. So all those things are pretty good for markets. And I think once you add up the general shape of what the economy looks like, you've got three major factors, I think, to look at, which makes me pretty upbeat. I mean, number one is that the Federal Reserve wants to ease. Number two, you've got a sluggish economy in the US, and sluggish economies that need to be stimulated are normally good for liquidity. So in other words, policymakers will start pushing a lot more cash into markets. And the third thing is we've got a lid on inflation pressure, certainly in the short term, because China is suffering deflation and it's trying to export its way out of deflation, which basically means that the world economy enjoys low or even falling prices. So you've got a backdrop here, which I think looks pretty good for financial assets for the next few months.